Welcome to Goldcore TV, and I'm your host, Dave Russell. And now for the weather. No, we've not lost it in all the madness of the recent heat wave. We are actually bringing you a real-life weatherman. Kevin Wadsworth is a meteorologist-turned-chart analyst who's found a way to utilize his 35 years of predicting the weather in the area of markets, charts, and predictions. Kevin joins us today to discuss how he applies his methodology and then takes us through the range of outcomes he sees for the economy, the US dollar, and precious metals. If you enjoyed today's interview, then make sure you're subscribed to Goldcore TV. Not only will you not miss another interview again, but you'll be the first to hear about new releases of our flagship show, the M3 Report. Our recently launched show brings you brilliant analysis from the Goldcore team, unseen chats with guests, and some excellent additional features exclusive to the M3 Report. But don't get too excited and run off and watch it just yet. Sit back and enjoy my chat with Kevin Wadsworth of NorthstarBadCharts.com. Kevin Wadsworth, welcome to Goldcore TV.
Hey, great to see you, Dave. How you doing?
Now, as a technical analyst, you have a unique way of looking at markets and looking at charts that is different to your typical technical analyst. Can you tell us about that?
Yeah, so my background for 34 years is in meteorology and weather forecasting, and a key component of that is assessing future likelihoods and probabilities. Use a lot of computer modeling in weather forecasting these days, but there's a whole science around how to predict the future, not just in meteorology, but in anything. And after 34 years in meteorology, I began to see a link between predicting the future climate and predicting the future price movements of stocks and shares, gold and silver, that kind of thing. So I started to experiment using the same ensemble forecasting techniques. If you like, I can share my screen, and I've got a graphic that kind of explains that.
Please do, yes.
Yeah, okay, right. I'm sure this is going to work seamlessly as I hit the screen share button. So hopefully you're seeing that now.
Indeed.
So what you're looking at there is, and if I just skip to the first slide, it would be useful, wouldn't it? What you're looking at there is a graphic that shows how you get from now into the future. So in weather forecasting, this could be a projection of temperature a few days ahead and various paths to various possible future outcomes. Now, it's absolutely essential as a forecaster of anything, any future event, that you accept that there's a range of possible outcomes. You'll often hear analysts saying gold is going to $3,000 or gold is going to $1,000. Well, no, it's not. It's scientifically, it's not. It's within a range of possible outcomes, and you have to assign a probability to each of those future outcomes. As you follow the path, say that you're following the purple path there, which ends up being a temperature higher than today or a gold price higher than today. As you move along that path, the probabilities constantly are changing. So as you go through time, you can't just sit still on your forecast and say, yeah, gold is most likely to hit $2,000 in 3 months' time. That probability and those possibilities are changing continually with time. This sort of results in this kind of outcome where you start off on the left-hand side of the graph. Here it's temperature, but it could be gold price at $1,700. And then you're progressing to the right-hand side of the graph there, where it could be a range of temperatures or a range of gold prices between $1,000 and $3,000, for example. And each one of those blue lines is a path to the eventual outcome. So in meteorology, we run a computer model over and over and over again. And we also compare it to the computer models that the French and the German and the Americans are running for our planet's climate and our planet's weather. And we compare all of those model forecasts. So what we're effectively doing, we're modeling every possible future outcome from the highly unlikely low end to the highly unlikely high end. And you end up with a distribution curve. And where that cluster of most likely outcomes occurs is where you want to put your money if you're betting on the markets, if you're betting on gold or silver or stock markets, whatever it happens to be, or if you're putting a bet on what the temperature is going to be. And I'm sitting here roasting in the UK in England in about 38 degrees at the moment. So our computer models picked out this heat wave 2 weeks ago. I know a lot of people like to say that weather forecasters can't forecast their way out of a paper bag, but technologies come on in leaps and bounds. And using these techniques, believe it or not, you can forecast future outcomes for prices of gold and silver. For example, this slide here shows the forecast that I put out in 2019. You can see the Twitter link there. You're free to use that Twitter link and go and see that it's genuine. So in 2019, I used this ensemble forecasting technique to gather the evidence for what was going to happen to the price of gold. And the evidence pointed to an arc formation completing, the breakout having taken place, and a back test shortly to occur. the back test occurred, as you can see in the bottom right-hand graphic there. And the bottom right-hand graphic shows you what actually happened as compared to my black arrows in the left-hand graphic, which was my forecast. So by putting the pieces of the jigsaw puzzle together and weighing all of the evidence, you can arrive at the most likely outcome. Doesn't mean that it's going to happen. Of course, you know, if there's another outcome that has a 1% chance of occurring, then that can happen. For example, there was probably a less than 1% chance of getting 40 degrees Celsius in the UK this year, and we're going to get it. So, you know, you cannot discount low probability outcomes, but what you can do is you can identify the most likely outcome. So that's what I, you know, that's my approach as an analyst. That's where I'm coming from, and that's how I approach it.
Okay, well, if we take that approach then and apply it to the metals market now, well, the first place that I'd like to start is actually the dollar strength that we've been seeing over the last while, because it's had such an influence on the metals price, particularly obviously the US dollar price of metals. Gold has been performing quite well in most fiat currencies. In dollar terms, it hasn't been of late, and that's a lot down to the strength of the US dollar. What's your take on where we are in this dollar index rally, this dollar rally, and how that's going to play out going forward?
Yeah, sure. So it's caught a lot of people out by surprise to a large extent, and I'm going to include myself in that because there was a lot of evidence that the US dollar would top somewhere near 101 to perhaps 102, 103. It's pushed through that barrier and it's pushed through the resistance lines. And of course, a resistance line on the chart it's just that, it's a resistance line, and price battles to get through it. And just because that line is there, it doesn't mean it's not going to burst through it. The fact that it burst through that level opens up upside targets, of course, which wouldn't otherwise have been achievable. So we have seen 105, 106, 107, that kind of area on the US dollar index, and 115 to 120 is a natural target at the moment. But what I'd like to point out on this chart here is, as far as the metals are concerned, when you zoom out a little bit, yeah, short term, a rising DXY, strengthening dollar can inhibit gold and silver price movements. But over time, you can see on this chart here very clearly that I'm just glancing to my left here because I've got my display on the left-hand side, but you can see very clearly since 2008, the US dollar index has risen from around about 71 to 106, 107, wherever we are today. But over that time period, gold has risen from less than $1,000 to a couple of $1,000, and of course it's pulled back to around about 1,700. So it's not entirely true to say that a rising US dollar index or strengthening dollar is going to cause gold to drop. It's not as simple as that, because there's a missing piece of that equation, and the missing piece of that equation is inflation. So if you think about it, DXY, what is it? It's basically the US dollar compared to the euro. Okay, there's the British pound and the yen and a couple of others in there, but it's basically the euro dollar pair. So this chart here that you're looking at shows DXY adjusted for inflation. You have to pause for a second and get your head around that, because you're kind of thinking, how can you adjust an index for inflation? Because DXY just varies between, I don't know, whatever it is, 60 and 160 over history. So it's oscillating between two values. But at any given point in time, over a period of, I don't know, a few months to a couple of years, the US dollar is either gaining strength against the euro or it's losing strength against the euro. So the DXY is rising or falling. But at the same time, you've got inflation going on in the background. So what this chart is telling you is that if inflation is overpowering that US dollar strength, then gold is not going to fall as much as you might expect. So when this chart breaks down, and you can see the breakdowns in 1985, 2002, and 2021, they mark a very important point in time where this ratio has made a decision, and it's made a decision to not hold the support line, to break down and start another leg down. And that's happening because with inflation outpacing US dollar strength versus the euro, that means that gold as a barometer of your purchasing power is not going to suffer as much as you might expect. Gold is doing remarkably well considering what the US dollar has done. It's risen from 71 to 106, 107. And it's held its ground. In fact, it's maintained its purchasing power. So don't necessarily be drawn into this narrative that US dollar strength is going to be bad for gold. But in simple terms, to answer your question, what do I think is going to happen to DXY, is that there are higher upside targets, as I've mentioned, 115 to 120. We're seeing weakness at the moment. I'm not entirely convinced that the US dollar is done yet with its onslaught on the euro, and a lot of that depends on things like what happens in the eurozone over the coming weeks in terms of Putin, gas supply, knock-on implications with energy crisis, no crisis. Does Europe fall into a complete chaotic mess over the coming winter? In which case, clearly, I would suggest that the US dollar is going to continue to show a good amount of relative strength versus the euro if the eurozone finds itself in that kind of economic mess. So I think we're going to get our answer fairly shortly as to whether DXY or the US dollar is going to continue with its strength. But I wouldn't necessarily write gold off just yet. Gold and silver, if you look back at the 1970s and look back at some of the analogue, we may well be approaching the sort of the 8-year cycle low for precious metals. I've got some charts here.
Do please, because I'm keen to see how you apply your methodology, and then have a look kind of at that range of outcomes that you're suggesting for the precious metals.
So myself and my colleague Patrick, we look at all of the evidence from all different angles. We don't rule anything in, we don't rule anything out. So this chart that you're seeing here marks what I see as some critical evidence for gold. So that evidence is very clear on this chart, and there's two very clear basing formations, geometric arc patterns that propelled gold to much higher values. Now we've just seen another one of these arc patterns taking place, and since we achieved the arc target, which I forecast back in 2019, we have, again, as I suggested would be the case, we've consolidated for a large period, a long period of time, to let effectively gold work off that sort of first leg up. My initial expectations, and I think probably my on balance of probability, my expectation is for gold to hold the 1680 level that you can see on that chart, and to move higher before we see a major low develop. But the problem that I'm having is that we are actually below the 3-year moving average at the moment. So history has shown us that when gold tests that 3-year moving average, it's moving into a major cyclical low. Gold tends to have its cycles every 7 to 8 years, and you can see on this chart gold has a very clear 7 to 8 year cycle ever since the US came off the gold standard. And so in the 1970s through the 1980s and 1990s all the way to now, there's been a very reliable 7 to 8 year cycle. You can see the quarterly chart here, and the length of time from one major cyclical low to the next. It varies between, I think it's 28 and 34 bars on that chart, was roughly 7 to 8.5 years. So we can identify a window in time where we can expect the major cycle in low cycle in gold to occur, and that's any time from the quarter that includes December of this year through to May of 2024. So it's a big window, because historically speaking there is some variability in the 7-year to 8-year cycle lows. So that gives us a little bit of evidence, and the fact that we're testing the 3-year, the 12-period moving average on there, the red line, is the 3-year moving average, and we're actually below that now. That tends to happen when we're at those 8-year cycle lows. It happened in 2008, of course, and we tested that low point, and then we went to that level and below during the long basing period, sort of 2014, 15, 16. So there are strong indications that we are advancing now currently towards that 8-year cycle low. So that kind of goes against the idea that 1680 is going to hold. So for me, 1680, 1673 to 1680, depends on the candle closes that you're looking at, on a quarterly basis, and certainly on a monthly basis as well, is going to be very important. If we close at any point during any month below 1680, then I start to suspect that lower targets come into play. If that level holds, then as you can see on the previous chart here that I showed you, the 7-year rate of change is actually in our favor. 7-year rate of change indicator on the bottom has not given a sell signal, and in fact it's just moving off those lows that we saw a few years ago, and it actually gave a buy signal back in late 2019.
And just for those that may not be familiar with that idea of the 7-year rate of change, can you just explain exactly what that's measuring?
So you take the so the point in time that we're at now on that 7-year rate of change indicator, that plot, that dot on the black line there, it's
Mm.
showing you overall over the previous 7 years whether the change has been to the upside or to the downside. So you can see it's currently above the 0 line. So taken as a whole, the last 7 years, the momentum is up and the trend is up. And you can see from the history of this 7-year rate of change indicator that it's picking out very long cycles, it's picking out very long-term trends. Well, it would be a long-term trend because it's a 7-year indicator. You know, you're choosing a 7-year period. It's 84 months or 7 years. I've overlaid the 3-year moving average on that so that you can see when it gives its buy and sell signals. It actually gave a very good sell signal at the top in sort of 2012, 2013 there.
Mm.
So what you're looking at is a long-term momentum, a long-term trend. It's one part of the evidence puzzle, but it's suggesting that the long-term trend and momentum is in our favor still. And as we move on in time, the new point on that indicator will cover a slightly different 7-year period. So next month we'll gain a new month and we'll lose an old month off that 7-year period. So it's one way of looking. It's almost like a moving average. You could think of it a little bit like a moving average. If you look at the moving average itself, the 3-year moving average that I've overlaid on it, it follows a very similar trajectory, but by overlaying the two, you can get a buy and sell signal, one slower than the other.
Okay, so on the upper chart there, what you have is you have your second arc that has been completed, and now what we're seeing out to the right there is it's consolidation rather than invalidation of that arc. So we're saying that we're potentially putting in a cycle low here, but if we don't hold the 1680, 1673 level that you're indicating on a monthly close, it will suggest that the cycle lows can be slightly lower than where we are now.
Well, if that breaks, then it'd be considerably lower. And a lot of that, I suspect, depends on whether we get a market meltdown or not. The S&P, in fact, there's a chart here I wanted to show you, which is quite key to all of this. The S&P versus, sorry, I've got a lot of charts here. Is that one there? US equities versus the producer price index. I apologize, it's looked a little bit slightly blurry on my screen, but
no,
you can see, you can see that this chart is showing that US equities have broken down versus the producer price index in the United States. So if you use the PPI as a proxy for inflation, it's basically an inflation adjusted S&P chart. And when it breaks down and you get a major trend line breakdown like this, it historically has led to a very long period. In fact, you can see there on the left-hand side of the chart, many years where S&P underperforms inflation. So if you're a hedge fund or a large, investment manager, you're going to take notice of this chart. It's not just me looking at this chart. You've got hedge fund managers all around the world looking at the same charts, and they're going to be taking note of this, and they're going to be realizing that there's strong indications here that S&P and general equities are going to underperform. Well, they are underperforming inflation, and we don't yet know when that situation is going to change. So what's the natural thing to do? Rotate. And you can follow these capital flows and rotations using ratio charts. So you can pull up a whole load of ratio charts for one investment vehicle to another, for example, gold to S&P or commodities to NASDAQ or whatever it happens to be. And you can follow these capital shifts. And these ratio charts are all pointing in the same direction, really. They're pointing to the fact that there's a shift in capital flows taking place at the moment away from general equities and towards commodities and towards, and this is notwithstanding the recent pullbacks as well, towards commodities and precious metals and base metals, and a whole range of energy as well.
And we can see that in that chart. If we look back at the 2007, as you have it on there, 2007 top for US equities. There were some very positive years for precious metals that followed.
Well, we know what happened after the sort of crash of 2008. Metals recovered very quickly, but the S&P versus inflation took much longer. And if you'd been invested in the stock markets at that point versus inflation, you would have effectively gone nowhere from, what is that on that chart, 2000 to 2000, I don't know, 14, 15, something like that. So a lost decade effectively.
History doesn't repeat itself, but it often rhymes.
It certainly does. It certainly does. And on that point, and also to mention the gold-silver ratio is very important, because we really need the gold-silver ratio to break down to really kind of kickstart a big sort of leg up in the metals, I think. So we need to start seeing silver beginning to outperform gold, which would cause this ratio to break down. It a little bit disconcertingly has a confluence of support lines in 2024. So if this continues to move up into early 2024, then gold and silver will struggle. So I'm watching this chart like a hawk for a breakdown.
Okay. And if we again apply this methodology to what's happening in silver.
Yeah, so this is the silver chart. I'm glad you asked that. So we've got an arc pattern again in silver, and these kind of arc sort of basing formations are very, very common across commodities and across, well, all investments really. And it's really just another way of looking at stage analysis, you know, from Stan Weinstein's stage analysis theory, or Wyckoff accumulations and distributions. So there's nothing voodoo or weird or wonderful about the way I draw these arcs. It's just another way of visualizing a Wyckoff accumulation phase. And so silver's been in that effectively for 10 years or so. It's been putting in this basing formation. We've had some exciting moves up to towards the sort of $30 area relatively recently, a couple of years ago. You can see on the chart there. But since then, we've gone sideways to down, and a lot of people are screaming manipulation and coming up with all sorts of theories why that's happened. But you just don't really need to think about these theories, because the chart tells you everything you need to know. It's basically telling you that it would be perfectly normal for the downside action to anywhere, perhaps down around that sort of $15–16 area. So if silver did fall to that level, all it's doing is it's reconfirming the arc that was put in place by the March 2020 COVID lows. You can just about pick out those lows underneath the flagpole that I've drawn there in March of 2020. So that created an outer arc there, which is there to tell us that in another extreme scenario, that's where silver is going to pull back to. So nothing unusual has happened, nothing that suggests manipulation or anything like that. It's just all normal price action. And we can't get excited about silver until we push through zone 1 and zone 2 there. That zone 1 and zone 2 that marked effectively have the top at $28, give or take a few cents, you know, here or there. So that $28 level is the crucial level that silver has to push through. And I'm sure other analysts that you've had on will have mentioned this. And it's very, very clear that level, whether you say 27, 28, or round it up to the psychological $30 level, when we break through that barrier, then we really know that something important is happening. Until we break through that level, it's just a chance to accumulate on weakness. You know, if you look at the risk to reward on this chart, the downside risk is a few dollars. The upside reward is, well, we don't know exact. Silver is a very spiky metal. It could go to 50, could go to 150 over the next few years. But if you look at it from risk to reward, really just relax, take your time, accumulate, be happy that you can get silver at these levels, because this chart is telling me that it won't be available at these levels forever, and very time limited up until the 8-year cycle low in sort of 2023 or 2024. So that's my view on silver. Same sort of thing for platinum as well. You can see the platinum chart, it's doing the same thing, being repeated across the metals. You've got this arc formation. Platinum historically undervalued now to gold, Dave. So, and again, I'm sure many of your analysts have mentioned this. And the advantage to chart trading is that you can pick the exact moment to enter platinum, because there's nothing to do at the moment because platinum's falling. I've identified this level anywhere between about $700 and $800 is the sort of ideal buying spot if we can squeeze it down that low, because the chart tells us that is a likely target somewhere between that $700 and $800 level. And we've got very close to that. This chart's probably a few weeks old now, so we've got very close to that level. So platinum and the platinum to gold ratio suggesting that we're getting closer to the end of this pullback than the beginning. Obviously, this has been going on for a while now, so we're closing in on that opportune point.
Perfect. And outside of precious metals, is there anything else that's catching your eye at the moment?
Yes, there is. I'm glad you mentioned that as well, because I wanted to just have a quick honourable mention for my personal favourite, uranium. Uranium broke out, uranium, the metal, broke out in 2018. Now, I was jumping up and down all over Twitter, screaming and shouting about it in 2019 when I opened my Twitter account, and I've been jumping up and down about it ever since. all sorts of fundamental reasons to support the case for platinum. I'm not going to go into those because the chart tells you everything you need to know. Here we've got the URA ETF versus the S&P. We've got it versus gold. We've got it versus gold miners, the GDX, and also against Bitcoin, just out of interest. And every one of those patterns shows the same arc formation, the same breakouts. You can see the moving averages crossing over. You can see URA versus these other investment vehicles gaining strength by moving above the key moving averages, moving through that funny red cloud-shaped thing on there that's called the Ichimoku cloud. When charts move through the Ichimoku cloud, it's a little bit like moving above the moving averages. It's another piece of evidence in the ensemble forecasting method that I talked about right at the start. It's another tick in the box. And as you get all of these ticks in the box, you're gaining evidence. You can see the stars there on the uranium versus gold chart. We award stars as the evidence is gained. You break through the wake-up line, you break through the early breakout line, you go above the moving averages with a bullish cross, you go through the Ichimoku cloud, and then finally the final breakout line. And it's like giving all of these green lights to what's happening with this particular chart. So you get the evidence stars, you take your position in the stock or whatever it is that you're looking at, based on your level of risk tolerance, of course. And if you want to wait till it's got its 5th star when the risk is low, you've of course already missed some of the move, but it's a safer entry. So that's the way that we do it. So all of these charts, I have to say, Dave, are telling me that the investment of the next 5 to 10 years is highly likely to be uranium.
Fascinating. And just for our viewers, where can they find out more about what it is that you offer?
Okay, so you can see the links here. You can find us on Twitter on North Star Charts, at North Star Charts, and at Bad Charts One from my colleague Patrick. Don't ask me why he calls himself Bad Charts. I think that was a little joke that he had there, but they're actually good charts, as I keep telling everybody. YouTube, it's North Star Bad Charts, and Instagram as well. So our website's there, northstarbadcharts.com. So feel free to drop in, have a look at the free stuff, and join us if you want to join us. If you like this kind of analysis, it's all there for you.
Perfect. Well, the URLs are on screen there. What I'm going to do is I'm going to stick a link to those in the description as well, in the show notes below this video. And we'd be delighted to have you back on again sometime soon, Kevin. But for now, thanks for joining us on Goldcore TV.
Thanks, Dave.
My thanks to Kevin for joining us today on Goldcore TV. And there were many takeaways from a conversation with Kevin, but something that I think is very pertinent to these times is what he said about forecasting outcomes. He said that when you're looking into the future, you must accept that there's a range of possible outcomes. This is why we don't do price predictions. You won't hear us say the gold is going to $3,000 or gold is going to $1,000, because as Kevin said, scientifically, it's not. It's within a range of possible outcomes. This is, however, why we recommend people invest in gold and silver, because you can't predict the future. You can perhaps see the clouds gathering overhead, but you can't tell when it's going to rain or how much it's going to rain or if there'll be thunder and lightning. But what you do know is that the weather is turning and you need to prepare yourself as well as you can. That's where gold and silver come in. We don't recommend you invest in them because they're going to $3,000 an ounce. No, we recommend that you invest in them because you just know that you need to be able to weather the storm that lies ahead, no matter how bad it is. Don't forget to check out our latest episode of the M3 Report and hit like and subscribe on this video and hit the notification bell so you can be reminded every time that we upload new content. And if you'd like to learn more about how to buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metals experts.